When I was interviewing for my first job at JP Morgan, someone said to me, "You are joining the trading floor. This can be a tough environment for a woman. What makes you think you can handle it?" And I said, "Try teaching 15-year-olds math. Actually, I think this is going to be just fine." We had a view that there was a business to be built that combined societal values with financial returns. Then we assigned this name to it, which was impact investing. We published a report in 2010 that declared this as an emerging asset class and defined impact investing as investing with the intent for positive social or environmental outcomes. Part of the reason I joined L&G is that it is grounded in its own values. And I think that institution has lived with those values for a very long time. I think we're a recognized leader from an asset management standpoint. For me, it's about the institutional retirement division developing its place in the world as an asset owner who is incorporating climate decision-making in our investment process. If you want to do something within an institution, you should not start kind of outside its fences. You should start inside the fences, where the strength of the institution lies. Because if you start outside, then you've got to get everyone on board. Moving someone 8 steps out of their comfort zone is a hard thing to achieve.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Yasemin, it's really nice meeting you, and thanks for coming on the show today.
It's a pleasure to be here, Scott. Thank you for having me.
You're speaking to me from London, but you were born in Turkey. So describe your early childhood there and tell me about your father and your mother and what your family life was like and what it was like to experience a coup d'etat and then move to America after that. And what were the emotional and psychological impacts that you remember most vividly?
I was a baby, actually, when my parents left. So I think the impact on me happened afterwards. But basically, I was born in Istanbul. I have a twin sister and an elder sister. So we were a family of 5. And my parents had studied in the US. My father has a PhD and my mother has a Bachelor of Fine Arts. So they had lived there and then they'd gone back to Turkey to have their family. And I think the coup that took place cemented a view that they had that they might feel better off raising their family in the US. They always talked about it from an educational standpoint, actually, much more so than safety and security. And it was only later on in life that they started to kind of open the window as to what the security implications might have really been like for them at the time. But they always said, yeah, we moved to the US. My dad got a job in Boston and he asked them, where in a 100-mile radius is the best public school? And that's where we landed. He looked at 5 houses. He chose one. And then they moved with 26 suitcases and 3 daughters to a small town in Rhode Island.
What year was this coup that it took place?
1980.
What was the security concerns?
It was actually my father's cousin who told me about an experience as a college student where he was in the classroom at university and some, I don't know what to call them, armed militiamen entered the classroom and took the students hostage effectively and marched them down to a cemetery where he then made them pray to an individual who'd been killed and was buried there as if they were a martyr for the cause. And then the police came and they arrested the whole group as if they were all part of this militia. My dad's cousin was not part of that. He was just a circumstantial participant in this who didn't really have a choice in the matter. And so I never heard stories like this as a kid. It was only something that I heard about much later in my life. I presume that these events translated into the decision to leave the country.
You have no memories because you were, 1 year old or not even?
Less than, yeah. So in my memory was going back to Turkey every summer, which felt very safe actually and warm because it was in the kind of embrace of a family summer together where my parents, siblings, and my cousins would all come together with my grandparents and we would spend our summer vacations in Turkey. So we would go back every year. So my experience was actually quite positive in the sense that I felt safe and secure there. It was also really eye-opening because, one of the things I remember from my childhood was you'd travel from Boston to Istanbul. You'd have to stop in Europe. It was an overnight flight, right? So it was a very long journey. And the last leg of the journey was an hour's drive from the airport in Istanbul to our summer home. And it was a dirt road. I remember vividly that feeling of leaving the asphalt and the car going onto the dirt road. And I always felt this is another world now. And we're kind of coming into this other environment that is not finished the way that my childhood was growing up in New England.
What was it like straddling these two worlds when you were young? How did that shape your worldview?
I think it was pretty fundamental to shaping me as an individual today in many different ways. One way was it led me to question the cultures that I was growing up within. Every summer, going back every year between school and vacation time in Turkey, you would have a US culture for 9 months and a Turkish culture for 3 months. And so it really shone a light for me on the differences. One thing, for example, was that the Turkish culture I lived in was very family oriented. So much so that everybody knew what everybody was doing and everyone had an opinion on it.
Yeah.
And in the US, it was much more individualistic, and the pros and the cons of the two sides of that became very clear to me, right? I loved having the support of a family, but I didn't love that everyone had a view on what you were doing and how you were doing it. And I really loved the independence I could forge in the United States, but sometimes I missed the kind of wider family network that was all the way across the ocean.
Was there a particular moment or observation those summers that you spent in Turkey that in hindsight today exposed you to different ways of thinking that you now can see that crystallized your interest in global markets or different economic systems?
Yes, for sure. So first of all, Turkey had a female president long before, the United States hasn't had one since, right? So there was a very clear role for women in leadership in Turkey. I'm just sharing that because I would imagine some people would think actually it's a Middle Eastern country. It would be behind in that regard. But actually, I was a math student. The maths department at the university was led by women. You had women in politics, a very strong gender lens at the time, at least. That was an inspiration for me. Second thing is when I finished university, which I studied mostly in the US and a bit in the UK, I decided to move to Turkey as an independent individual. So I went on my own. I got my own job. I had my own place to live, which was a very different experience than being a child in the kind of embrace of a family home and family life. And that experience led me to feel firsthand the impact of currency volatility and inflation. I was living on my own, so I would go into the shop and buy 2 tomatoes and half a lemon. And then how much that cost was literally going up week on week. Actually, before I moved to Turkey, I had finished university thinking I would be an academic. I was going to study pure maths. I'd applied for PhDs in that subject. After living there, I thought, actually, I'd like to understand this thing called the economy. Its implications on individuals' lives is very vivid to me now in a way that growing up in the US in the 90s didn't feel. That felt like a very protected experience from an economic standpoint. And so that totally changed my career path from academic to wanting to work in financial markets.
You told me that you somehow knew that you were an investor at a very young age. How did you know that?
Okay, so I always knew I wanted to study abroad. And when I went at the age of 16 to investigate which university might be right for me, the first question I would ask them is, what is your study abroad program? Where can I go if I come to study here? And so when I actually arrived at my third year of university, junior year abroad was in front of me. I went into the study abroad office of University of Pennsylvania where I was. And I said, I would like to go to Senegal. And they said, that's fantastic. And I wanted to go to Senegal because I wanted to go to Africa to the point of understanding developing economies. And I wanted to go to French speaking Africa because I was in an immersive French program. And they said, that's fantastic, but we have a scholarship to study in Scotland. It's $12,000 and no one has applied and the deadline is tomorrow. As a student who'd earned $3 one month in my very badly fitting job trying to sell student newspapers, This scholarship was a huge opportunity for me financially. I started working at the age of 15. I paid my way through college by myself, basically. So I couldn't turn that down. But what I did do was I said, $12,000 is a lot of money. I'm a very frugal person. I can live on $6,000 and invest half of my scholarship. My presumptuous self walked into the bank at age of 18 and said to the person, I'd like to find a financial advisor who can help me invest $6,000. The story is very exciting in the sense that it showed me that this was a career I was interested in early on, but it was very disappointing in the market timing. And that was one of the key lessons I learned. So the financial advisor said, you're 18 years old. You should invest in growth equity markets. This is a long-term investment for you. It was 1998. So it was the dot-com bubble.
All right.
So my investment went up very briefly and then crashed so significantly that I think it took me something like 10 years to make that original $6,000 back.
Tuition payments in the School of Hard Knocks. You probably learned a very good experience with that, but it was a little bit painful. So let's talk education. In 1998, you studied mathematics and philosophy at the University of Pennsylvania, which is fascinating because it's not an obvious combination to me. So walk me through that decision and what attracted you to those particular disciplines and how did they influence you?
My father has said since I can remember, be a woman in science, you will stand out. And for me, that translated in maths. And I would say it came naturally to me when I finished my high school exams, which was a college level calculus class in that final year. I had taught the whole class. They found the teacher impenetrable, and I had kind of in the background helped them get up to speed on the topics so that they could pass the course. I finished the course. I got top marks, and I remember bending down to tie my shoelace outside the school thinking, this is like tying shoelaces. Why would I study that? So I actually went to university not to study maths, thinking that I had done it all, which is a very arrogant thing for a young person to think. But it meant that I went to university with a wide open canvas of trying to discover what would be interesting to study. And I went on a liberal arts program. I just met the language of philosophy. There was somebody at the inauguration of the university class who gave a lecture on philosophy, and it just captured my imagination. And then it also made sense to me that I always loved logic puzzles as a kid. It was one of my favorite things to do on the plane ride to Turkey, actually. I used to buy these books and just flip one puzzle after the other. And I figured logic was the connecting piece between philosophy and maths. And the last thing I felt I'd go crazy if I did just one but not the other, because philosophy can be really open-ended and you never close anything down. You just keep generating more questions and more counter arguments. Whereas in math, you can have a very clear answer, but I needed the kind of creative space to expand the possibilities beyond that single answer too.
After graduating, you did not jump straight into finance, but you either bought a one-way ticket to Turkey at the age of 22, which is gutsy, or you became a math teacher in the Barrington Public School System in Rhode Island, which is also gutsy in quite a different way. Tell me, which was it and what was going through your mind at that point in time?
The chronology is that they kind of happened back and forth together. So I graduated in the summer. I went back to Barrington, Rhode Island, where I'd grown up, and spent the fall teaching as a substitute teacher, applying for master's and PhD programs. And then in January of that year of 2003, I left. I spent a month traveling around Thailand and Cambodia, and then I arrived in Turkey. And that was until August. And then I went back. I had deferred my master's program for a year to basically see where the Turkey adventure would take me. But after 9 months there, I realized that I wasn't going to do the PhD. I would do the 1-year master's to determine my path to academia versus practice. And that's when I went back to Rhode Island and taught full-time as a substitute teacher for another 9 months or so before coming to London to do my master's degree.
And so did teaching middle and high school students in Rhode Island give you any insights that have carried over into your leadership roles?
Oh, yeah, hugely. In fact, when I was interviewing for my first job at JP Morgan, someone said to me, you are joining the trading floor. This can be a tough environment for a woman. What makes you think you can handle it? And I said, try teaching 15-year-olds math. Actually, I think this is going to be just fine. I think it left me with a few lessons. First of all, to this day, that was the hardest job I've ever had. Teaching young people, is not about the subject matter. It's about connecting with them, understanding the challenges that they're facing as people. And then you get to the subject matter, right? You've got to find your way in, and then you can land the learning. Second thing I learned is that you make promises, you need to deliver. And that was a fascinating learning, because I had told the kids that there would be a quiz the next day. And then they came in and I said, there's no quiz, thinking they'd be happy. But they were really upset because they had studied. And when you say it out loud, it makes sense. But in the moment, it made me realize that actually, if you set someone a task and you say, I'm going to hold you to account for delivering on this task, they then want you to follow through. And so would I. That was a key learning. And the last thing I learned was performance. So I like public speaking, but teaching teaches you how to do that. You need to be on 7 hours of the day. It's a long time. Right? You have to stand in front of all these classes and you need to be on your game. It is a proper performance. You need to be prepared. You need to be ready for whatever comes at you, and you need to stay calm. And I think that had a huge impact on not just my leadership style, but perhaps my influencing style, how I engage with boards or governance committees, media interviews.
Yeah.
Yeah. So I'm really grateful for the time as a teacher. I think it was an incredible opportunity.
That is something we all experience having gone to school. Very few of us actually experience being on the other side of the classroom. I can't even imagine. So these experiences are what led you to King's College in London to study financial mathematics. I'd love to hear about that transition.
So that was a 1-year master's for me. Some people did it over 2 years part-time, but it was a real immersion into financial mathematics. And I didn't have the philosophy creative space happening at the same time. I was really just focused on this. It was great. I mean, I felt that it exposed me to a really different learning culture. So studying in the UK, where you're left very much on your own devices. Maybe there were assigned texts, but there were not assigned pages of those texts. Whereas in the US at university, you're very much handheld. Read these pages, your assessment will be on that, and you're kind of guided through the steps. And you had deliverables every week. In the UK, it was one set of 8 exams at the end of a week in May that determined the grade for the entire master's degree. Never mind what I was learning. What I was learning about was, how can I learn in this new system? Because that was not playing to my strengths. I am much more of an incremental thinker, and leaving me on my own all that time was really challenging. But I also really enjoyed the technical learning there. It gave me aspects of the maths, but also understanding the capital markets. And it was that exposure to, I can sit in a classroom and talk about pricing financial derivatives, but why would you do that? So it was really my experience at King's that made me think, I think my pathway is really cemented the decision not to go to academia, but rather to go into the capital markets.
Were there mental models or frameworks that you had to adapt to as you moved from theoretical math to the applied world of finance?
So maybe the way I'll answer that question is in thinking about when I had landed at JP Morgan and was looking at the global financial crisis. So in 2006, in the autumn, I landed a role as a credit derivatives analyst on the research desk, supporting the trading desk at JP Morgan that was trading correlation. That meant trading the different tranches in a synthetic CDO. Okay, 2006, I sat down in the chair. We head into 2007. Summer of 2007, you start to see rumblings in the global capital markets. August of 2007, I published a piece that was called So Long Correlation. And it was my stake in the ground that the correlation markets were about to shift. And it was prior to Lehman, prior to some of the kind of significant milestones of the GFC. But what I started to notice was the track record of analysis that you had in synthetic CDOs was very short. There was no history of credit cycles that we could look at if you looked at the past data. It wasn't like equity markets where you could evaluate what had happened before. So operating purely based on historical analysis was not going to get to the right answer. Operating purely based on financial models and pricing models was also only going to be a part of the answer. So to your question about the theory versus the practice, the theory helped me because I understood what was driving the pricing, because I understood the models. But what really got to the right answer for me was thinking about the behaviors of different investors who were holding different pieces of the capital structure. So there were certain investors, we called them fast money at the time, hedge funds, who could move quickly. They were in the junior tranche. And then there was capital that was more like pension funds or insurance companies who were in the senior tranches. And the way those organizations behaved, the decisions they made, and what they were trying to achieve with those positions made a difference to how they responded and how they would react to the crisis as it unfolded. And that was really the thing that I didn't feel I got in the land of a classroom studying financial maths, right? It was the behavioral elements of how different investors affect what's happening in the market. And that was a really exciting moment for me. I mean, it was a very challenging time, but intellectually, I found it fascinating to bring together the technical and the behavioral. And actually, what I put forward was a very contrarian view, but it played out in the way that the market transpired.
After you got out of King's College, as you've alluded to, you landed at JP Morgan, but first I think you were on their alternative investments team. What were your career ambitions at the time you got out of King's and landed at Morgan? Did you have a specific vision?
Yes, I wanted to eventually get to a place where I could go and work on development questions in a place like Turkey. But I knew that if I wanted to get to a seat like that, I needed to first understand global capital markets. And so the aspiration was find a seat that would give me a wide vantage point. But in order to get there, first you have to get in the door. And so my first role was actually a role that built off of my master's thesis. So my master's thesis was about fund-linked derivatives. It's a really random kind of topic, and it was a very niche subject, but there happened to be a team of people at JP Morgan who were structuring fund-linked derivatives. And somehow by some magic, my thesis landed in the hands of that team. And so they called me in for an interview and I joined. That was the first team I joined.
Around the 2010 timeframe, you made a fascinating pivot to becoming a founding member of their JP Morgan social finance team. I'd like to know how that opportunity materialized and why were you drawn to that?
So that linked right back into my motivation for joining the bank in the first place. I always wanted to land in a seat that brought economic development in line with financial maths. That was my kind of the inspiration in my heart. I didn't think that I would find that seat within JP Morgan. My premise was that I would do a few years in capital markets and then probably have to go and do a development finance or development economics master's degree and then find my way. The only place I could think of where you could do that kind of work was the World Bank. So I had no idea how my path would lead me to that within the seats I was in JP Morgan. So when the social finance team opened up recruiting, it was like my dream job had arrived at my doorstep. I couldn't help but apply for it.
This is very early doors in impact investing. And as you say, was somewhat of a extraordinary time in global finance. What was the social finance team?
Yes, it was a bit of an experiment. You're right. We had a view that there was a business to be built that combined societal values with financial returns. And then we assigned this name to it, which was impact investing. We published a report in 2010 that declared this as an emerging asset class and defined impact investing as investing with the intent for positive social or environmental outcomes. I remember spending 4 months discussing whether the word intent should be a part of that definition or not, actually. And today, I think it was a crucial decision that we kept it there.
What were you trying to accomplish with this social finance team?
Well, so the team had 3 pillars. One was thought leadership, education, building the brand of impact investing. 2 was advising clients who wanted to develop their own either corporate strategies or investment strategies. for this type of product. And 3 was we had a proprietary allocation of $100 million to invest in the emerging asset class itself. And my personal vision in joining this team was I felt we could build a business for JP Morgan. I thought that the pathway would be to move into asset management and develop products that we would then raise capital into, and that would channel, private capital into the areas of the world that the SDGs have identified really need access to private capital to drive forward. So that was the vision I had in joining the team.
What resistance did you or the team face when you're trying to get this off the ground?
I think the biggest challenge was that we were trying to build a part of the business where our starting point were private equity funds in emerging markets. And that was not the bread and butter of JP Morgan's investment bank or asset management at the time. And so one of my lessons is that if you want to do something within an institution, you should not start kind of outside its fences. You should start inside the fences where the strength of the institution lies. Because if you start outside, then you've got to get everyone on board. And there's, moving someone 8 steps out of their comfort zone is a hard thing to achieve. If you try to pull someone, lead them 1 step out of their comfort zone, they may follow you. So that was, I think, the biggest challenge. It was a sector, a product, and a geography that wasn't really aligned to the core principles of the bank. And this is post the financial crisis when all banks were kind of, battening down the hatches, but really focusing in on their strength areas.
Do you recall any defining initiatives that the team worked on?
I'm really proud of 2 in particular. We had an opportunity to work on behalf of the UK government, which, started with a phone call from then Prime Minister David Cameron. And he basically phoned us up and said, there is a looming demographic challenge, which is dementia. And if we think about it societally, dementia is, we have an aging population globally. It's a disease that we don't understand. We don't even know what the cause is. It's hard to diagnose. And when you look at what pharmaceutical companies were doing to help treat either the symptoms or the cause, they were finding a 3% chance of success in that disease area. So their decisions were to actually lean out from investigating in that life sciences research. And so he said, what can you do with the social finance toolkit to try and channel more capital towards that research? And that was just a fascinating challenge. It was really powerful for me at the time because my grandmother had dementia and my sister was working with dementia patients as an occupational therapist. And so I felt this was a really meaningful thing for me to be able to work on. Well, we brought together the pharmaceutical companies who each as individuals were stepping out because they said the space is too risky. We brought them together and said, well, if you share that risk, can you then step in with funding? Share the risk, right? So you reduce each of your exposure to it, but also you could generate a pipeline. And then we had a way of kind of setting it up at an arm's length in a competitive process that you could access, and you could channel further funding to things that were actually emerging from the pipeline as potential candidates for a successful disease treatment, or if we were really lucky, cure. And so we did launch the Dementia Discovery Fund. It's being managed today. We managed to attract, I think the last time I checked, the AUM was over 250 million pounds or dollars, and attracted the likes of Bill Gates, who has, significant contributions towards global health agenda. That has felt like a really meaningful project from my time at JP Morgan.
Were you really advisors as opposed to investors?
Well, we didn't invest in that one because it was out of the scope of our investment portfolio, but we advised the Gates Foundation, yes. We structured the fund vehicle itself and we raised the capital. But in other funds, we advised, structured, raised, and invested. So we kind of had 4 ways of engaging with product development.
A few years after that, you joined the Omidyar network, which of course is a company founded by the eBay founder, Pierre Omidyar, and his wife, Pam. And they operate with kind of a hybrid, maybe venture capital and philanthropy model. Can you deconstruct what Omidyar network is about? And your LinkedIn profile says you were doing intellectual capital while you were there. So what did intellectual capital there mean in practice?
First thing to say is that Omidyar network has changed a lot since I was there. They've actually changed dramatically from what was at the time emerging markets venture capital to today, I think a lot more focused on the US and a lot more grant making and advocacy. So I'll talk more about what it was at the time than what it's doing today. But at the time, the spirit of it was, I think Pierre came into it thinking eBay had an impact on people very easily in a way, right? What he did was provide a platform for people to put a product forward and find a fair market price for it. That had a positive impact, but through a highly successful commercial model. And so his idea was, let's see if we can find other models like that globally. And there were different thematic areas. So there was a portfolio around education. There was a portfolio around financial inclusion. There was a portfolio around governance and civic engagement. And each of these different initiative areas used two, or you might call it three, ways of thinking about servicing their impact thesis. So if you were after financial inclusion, or I worked on digital identity, for example, you might use commercial investments into venture capital startups. You might use less commercial investments where you might break even, but you're not looking for a high investment return, but you see high impact return, or you might make grants. And then you might also use advocacy, which is not a funding tool, but kind of more of a resource in terms of people's time. The spirit was, let's use all the tools in the toolkit to try and have an impact on a sector. And so when we were working on digital identity, for example, we did have VC investments. We were grant making to advocacy organizations to sponsor, for example, in India, the privacy agenda as their digital identity was rolled out. And I just found that to be a very holistic, well-constructed model of engaging for social change because it felt comprehensive across all the tools you could use. The intellectual capital team was a construct of kind of internal innovators who were following threads for new ideas. And so the digital identity portfolio grew out of just a new idea that we were watching India transform. They developed a technology stack that included digital identity, but also unified payments. And then we started kind of following the thread and saying, actually, could this be a sector going forward? This is before Apple Pay or Google Pay. This was 2014 or so. And so intellectual capital, our job was actually to keep the firm in a dynamic way, looking at new emergent sectors and decide whether they were things that we should be growing our work into, or maybe they're just a passing fad and didn't really warrant our attention.
Let's talk now about your move to the CDC Group, which is now known as the British International Investment, or maybe even better known as BII. So for listeners who aren't familiar, could you break down BII's mission and its theory of change and draw the big picture of how that entity operates?
So British International Investment is an institution that has a 75-year history and has been investing on behalf of the UK government into different countries abroad. And the current geographic scope is Africa and Asia. So while I was there for 6 years, that's where we were working. And the spirit of that is the funding comes out of the UK government's aid budget, but every investment that we would make needed to earn a return financially, but also have an impact thesis for sustainability, inclusion, or productivity. It was investing across private markets, so private credit, private equity, or fund structures, and investing in infrastructure, corporates, and financials as far as sectors go.
Why did you make the switch to go there from Omidyar Network?
Well, I had been advising them since 2013 on this kind of experimental portfolio, which they had been working to build. It was if you invested with more uncertainty, so things that were maybe first time funds, startups, but also new platforms or new sectors that didn't exist. So you didn't have a track record to look at. If you took that kind of risk, could you potentially have extra impact and be even more catalytic than the kind of main portfolio investments could be? So I'd been advising them on this portfolio from 2013. And in 2018, they recruited a CIO to oversee that portfolio. And so I joined as, it was deputy CIO of the firm, CIO of that portfolio. It was really exciting for me because I'd seen it since the origin. Their aspiration was to really institutionalize the approach, grow the portfolio. And I think I took it from about 300 million when I joined. It was about 1.6 billion when I left. We gave it a name. It didn't have a brand at the time I joined. We called it the Catalyst Portfolio, defined its purpose, expanded it from purely funds investing to all products that we were investing with, expanded it from just a few geographies to all the geographies where we were investing. And also our operating model had been kind of a team sitting alongside the main investments team, and we made it something that was much more integrated for the firm as a whole.
I'm going to pick your brain a little bit on BII because I think it relates to everything you're doing now because it's an interesting place. If I understand it right, BII targets a modest annual return. I think it's something like 2%. And then the returns are supposed to be reinvested for maximum impact. And the idea is that this allows it to be self-sustaining. If I've got that right, explain that to me, because that's a completely different model for most investment firms. And how does that modest return target fundamentally change the investment approach and the time horizons?
It is exactly, as you say, a very unique context in which to be investing. It's a very low return hurdle for most investors. And I think the premise is all the way back from its founding days, do good without losing money is the tagline of one of the founders. The return hurdle is effectively set at what our operating cost ratio was. So it was literally do good without losing money.
I'm particularly curious about the sector focus at BII. What factors determined which sectors you would focus on? And how did you identify these sectors that offered both meaningful impact potential and sufficient financial returns? Everyone says they want to do this, but you did it. So how did you do that?
I would say that rather than sectors, it was much more about the business models. So you can look at the agricultural sector, for example, and you can have successful business models that meet both your impact and financial thesis, and you can have very unsuccessful models. So it was, to me, it was much more about the individual company structure, what they were trying to achieve and how they were doing it. Thinking about things like solar irrigation pumps. Okay, so like any product, you have to develop a pump, you have to buy inputs to create the pump, you have to manufacture the pump, and then you have to distribute the pump. So there's a whole kind of value chain that you need to cover the costs for, and then you need to set a price that also earns a profit, right? So what if you do that and you identify that the price you need to charge doesn't fit the affordability lens of the consumer base that you're targeting? The farmers who would actually benefit from using this pump can't afford the price it would cost you to produce and earn a margin. An institution like BII can think about that by tapping into some concessional finance that can be available in the development finance space for climate mitigating or adaptation investments. And so by combining some more commercial capital with some more concessional capital, you can actually think about how to bring that story together. But the thing that we did in this case that was quite exciting was we thought about using carbon credits as a revenue stream to augment what the customer pays. We didn't really know what the market, this is where that risk appetite comes into play. We didn't really know what the market would be for those carbon credits. And so we said, we have the risk appetite to underwrite what that could be and experiment with it. We use the right kind of funding to do that, which is the kinetic funding, which there's more information on our website. And then we were able to reduce the price for the farmers so that they could buy the pump. And I don't know actually today where that has gone exactly, because it's now been a little while since I left, but I hope that the thesis we had that bringing together the right kind of concessional capital, taking some extra risk as a risk tolerant investor, and kind of thinking about the fundamental economics of product production, sales, distribution, manufacturing with customer price absorptive capacity, that all of that has worked together to actually achieve a business model that achieves financial return and impact.
But the pressure dynamics must be completely different when you don't have any external investors demanding quarterly results. And at the same time, you're aiming for modest target returns. How did BII think about the impact and return trade-off?
That's where I think relationships were really key. That's where you really are forming a partnership between two institutions, the investor and the investee, and the other investors around the table. And so alignment, open dialogue, really dynamic and active conversations, visiting on site, understanding what's happening on the ground, having that local perspective. I didn't feel like it was, wagging the stick of quarterly share price volatility, but I felt it was equally effective, if not better suited to what can be really long-term change and growth that you're trying to drive.
When you were evaluating potential investments at BII, what were the non-negotiable financial criteria and what hurdles could cause an investment to get rejected at the investment committee stage, even if the impact case was compelling?
Well, it was non-negotiable that you had to have a net positive base case financial return expectation at the time of investment. And we had different expectations for growth and catalyst portfolios. We also, I would say, had non-negotiable boundaries around things like business integrity. So knowing that the company was operating soundly within, global KYC, anti-money laundering.
While you were at BII, you helped develop their impact measurement approach. And that includes the impact dashboard and the impact score. And of course, this is something that many organizations struggle with. What catalyzed the development of these tools while you were there, and what gaps were you trying to fill in?
Well, I wouldn't take credit for developing those tools, but I was a part of the leadership that approved them for implementation. But I wasn't one of the architects, so I would just clarify that at first. What I would say is that we developed an asset allocation framework, which utilized the impact score alongside the financial return expectation, alongside a risk score, and alongside a liquidity measure to develop a 4-dimensional way of looking at the portfolio as a whole and each asset as it was coming into the portfolio to help us construct a vantage point that meant we could appreciate the contribution of each asset. So maybe one asset was really high impact but low liquidity without necessarily expecting every asset to deliver on all 4 dimensions. That was going to be an impossible ask. If you expected all assets to be high impact and high return and highly liquid, basically you have one asset in the book. So the impact score was developed, I think, for a few reasons. From my standpoint, it was a really crucial part of unlocking our ability to then use this quantitative asset allocation model. It was also used as part of the incentive compensation structure. So our performance reward system was linked to financial performance as well as impact performance, which the score was used to measure.
You mentioned these dimensions, and you said that there were 4. My research shows me that there's 6 dimensions.
You're talking about the impact dashboard,
Yeah,
which is one of the tools for measuring impact, and there's a score. But the score is what fed into the asset allocation framework, which is what I was building.
What was the dashboard then?
The dashboard is a way of looking at every investment. So every investment was evaluated qualitatively and where possible quantitatively against who was being impacted, how were they being impacted, how much were they being impacted, what was the risk around the impact, what was the contribution. That was the dashboard for impact.
I'm just trying to sort this out. It's very interesting stuff. Everybody's trying to sort out how to do this.
The BII impact framework is top class. I think it's really market leading. I just wasn't one of the architects of it, so I don't want to take credit for having developed it myself.
Sounds like you were sufficiently in the weeds on this. How did the impact score roll up and then give overall portfolio level insights then?
Every deal was scored, and then every pipeline deal was scored. So we could look at the portfolio as a whole. We could click into subsets of the portfolio. We could see, for example, did the equity portfolio have more impact than the debt portfolio? Interestingly, we didn't find that conclusion, even though a lot of people had the hypothesis that we would. Or we could look at different geographical subsets, or we could look at sectoral subsets. And then we could also look at the pipeline and see how it fed it in that way.
Who are the stakeholders who are most interested in the portfolio-wide insights?
It took us about 3 years to build all of the pieces to make this possible, from developing the impact score to developing the asset allocation framework that it plugged into, and then running the analytics on the portfolio and the pipeline. That whole time frame was about 3 years. And so I still remember that July meeting with the executive committee where we presented the outputs, and people said, first of all, this is the first time we can visualize the constituents of the portfolio and what the total sum looks like. And secondly, it helped us understand where some of the trade-offs were and weren't. And we have published on some of this. So you can find it. There's a Harvard Business School case study, or you can find it on the BII website. But for example, we did not find a trade-off between financial return and impact. But we did find a trade-off between impact and liquidity. That's really eye-opening if you're trying to think about portfolio construction as an executive team within the firm.
BII invests in markets that most traditional investors avoid. Were there certain risk mitigation strategies that you used that proved to be the most effective?
I think alignment with the investee or the fund manager, whoever your counterparty is across the table, was a really important risk mitigation strategy. At the end of the day, the successful investments were not based on agreeing things on a piece of paper. They were really fundamentally two aligned parties coming together. But another risk mitigant was also having alignment across investors. So we would work through, for example, the terms of a fund limited partnership, such that we could think about voting rights and thresholds, so that if things were changing and we needed to have a voice at that table, we could do that in a way that was, well balanced across the investor base. And having investors alongside us who were aligned gave us the comfort that we could have the dialogue with the level of commitment across investors if the need arose over time.
You've been very vocal about catalytic capital as a lever for mobilizing private investment into the emerging markets. And you've also been vocal about the role that institutions should play to crowd in additional private capital. For listeners who aren't familiar with the concept, could you explain what catalytic capital is and why it matters so much in mobilizing private finance?
So catalytic capital to me is capital that will step into a space others won't, as you said just a moment ago. And that can be an environment where, for example, BII used catalyst funding to back a platform called MedAccess, where it was the sole funder of MedAccess, in fact, founded MedAccess and developed the platform to provide volume guarantees in pharmaceutical development to help encourage manufacturing companies, for example, to develop lower cost products. So they would lower the cost if we would guarantee an offtake that we would buy at a certain price. So that was the volume guarantee model. And BII was the sole funder of that with Catalyst, because it was a model that was trying to bridge what was a nonprofit world with a kind of commercial world. And we didn't know whether it would work. But there's another model of catalytic capital where you can use it to incentivize institutional investors to come in alongside development funds. So, for example, if there were a portfolio of assets that BI was originating, let's say loans into financial institutions in Africa. From my current seat at Legal in General, it would be hard for me to take exposure to that directly. But if BI put Catalytic Capital Junior to my capital and I could be senior to that, perhaps that would give me the credit enhancement to get the credit rating of an investment grade asset. And that could then be potentially eligible for me. So there's that kind of catalysm as well, where you're bringing institutional investors in at the same time by helping to kind of manage their credit exposure.
When you were attempting to crowd in private capital, who were your primary targets?
I really liked working with institutional investors where there was a third-party validated reason why they needed some kind of catalytic capital. Because at the end of the day, catalytic capital is a subsidy. You are taking less return over here and giving it to, it's government funds taking less return and giving it to commercial funds. So why would you do that? It never felt comfortable to do it because somebody said they needed it. Because anyone can say that, right? But if someone said, well, my regulator says I need X, my credit rating agency says I need Y, Therefore, this is what will make this product work for my portfolio. That felt more validated from a third party standpoint, right? And so to me, that felt like a more comfortable place to be. And so that meant, yes, it could be insurance companies like Legal & General, who's under a Solvency UK regime that's very strict and clear about what the guidelines are that we need to invest against. It could be pension funds, but having that validation of a third party model or boundaries was really important to me.
Before you said you weren't sacrificing anything between returns and impact, but in this case, you're admitting that you need a subsidy in order to actually attract private capital. How do you feel about that? Why is that if there's really no trade-off?
So I think the way we found it was there was no trade-off of the assets that BII was investing in and within the constraints that BII needed to meet. But the constraints of an institutional investor that is managing pension fund assets and operating under a regulatory regime like Solvency II or Solvency UK, the premise is very different, because what I'm looking at here, the universe of assets, if the universe of assets from the current seat I'm in is a foot wide, right? The BII universe would be maybe a centimeter of that foot, or an inch if you want to stay in the imperial system. It's a really narrow slice of the product set. And the benchmark for BII, right? When I said we didn't sacrifice returns for impact, that was against the 2% return hurdle. Whereas here, the return hurdle is very different. Yeah.
Last year, you made a significant career move to Legal & General as head of investment strategy in the institutional retirement division. How did that change come about, and how does your current role link to or build upon your experience at BII?
Thank you. I think that was about 18 months of my introspection to figure out and then achieve that transition. So I think it'll be an interesting thing to talk through quickly. Coming into 2023, I had worked for 20 years across financial services, not really counting my time as a teacher. And then I started thinking about the 20 years in front of me and what did I want to achieve. And long story short, I realized that I love being a CIO. So I wanted to continue in the type of job I was doing, but I wanted to expand the vantage point of the seat I was in. So CIO at BII was private markets and only in Africa and Asia. And what I felt was I was losing touch with what I'd done at the start of my career back when I was working in derivatives at JP Morgan, around the financial crisis. And so I wanted a seat where I could go back into public and private markets, emerging, but also developed markets, and really, as broad as I could get. So that was one objective. The second objective was I felt that the insurance sector itself is poised for innovation. And that was looking at trends, for example, across the asset management industry, where it just feels like, people are valuing less active management and paying fewer fees for active management, right? Switching much more into passively managed funds. So the asset management industry as a whole, I think, has been asking itself, what's our future if A is at risk and fees from A is at risk? And I think that's why we've seen the likes of Apollo move into insurance, because there you can kind of claim liabilities that fund your business, right? And then you can invest against those liabilities. And then your profit is the return you make in the spread between your assets and liabilities. And so I thought that joining an insurance company at this time would be an interesting space to watch that trend grow. And of course, the defined benefit pension schemes transferring their assets over to insurance. There's a trend in the UK, 16% of the market has been transferred to date. That leaves 84% still to be done, right? So there's a huge opportunity in the next decade to bring that transfer of assets from pension fund management into insurance company management. So wouldn't it be fun to be a part of that story? Great learning opportunity. And then the last thing that was really compelling was the new leadership at L&G. So we have a new CEO. I think he brings a really different style and energy to the business. And I just felt like it would be a really exciting time to be part of that journey with him.
Give me the helicopter view of L&G and then specifically L&G's institutional retirement division, which is where you're working at.
So the helicopter view is we've got 3 divisions. Asset management is one. That is managing the dominant portion of our assets, but we are the asset owner in institutional retirement. And then we have a retail division as well. The portfolio that I'm looking after is UK pension liabilities to get across institutional and retail. And then we also have a portfolio in the US and in Bermuda. So we're bringing together the lens across the whole of that. And that's what constructs the 100 billion. We have a CIO in the US and a CIO in Bermuda who manage them locally, but the aspiration is to kind of have a top-down view across the whole.
The 100 billion portfolio, is that sterling or is that dollars?
That's sterling.
Give me a quick flavor of the portfolio in terms of asset class and geographic exposure and investment objectives.
So the portfolio, as you might expect, it's predominantly backing UK liabilities. So we have UK asset exposure across a lot of fixed income, different assets in credit, property, infrastructure. And then, of course, we have a footprint in the United States as well with a significant presence in terms of our asset base there.
Pension funds have these extraordinarily long-term time horizons with long-dated liabilities stretching decades out into the future. How does that long-term perspective shape your approach when you're considering things like climate risk? And how do you connect this to L&G's broader climate strategy?
So we have a decarbonization objective, which is to decarbonize by half from our 2019 baseline by 2030. I would say we're making really good progress against that. I think we've achieved about 30 percentage points. So we're kind of done 30. We've got 20 to go if you want to look at it that way. What I would say is what we've done is the easy work. So, rotating to find, the carbon efficiencies in the existing portfolio. What I think we could do from here is finding opportunities where we can support either carbon positive or even, it's always hard to talk about this because by carbon positive, I mean negative. What we want to do is have more of an allocation to assets that will improve our carbon emissions intensity in the book. More importantly, actually have a real world impact on the lives of the people whose pensions we're managing and other kind of stakeholders and beneficiaries around them.
What's the difference in your approach to the new investment positions that you take on and the due diligence process behind that versus the strategy you take with existing positions and the impact that they have through perhaps active engagement?
I think in existing positions, we have probably more of a monitoring approach in terms of seeing the contributions of those assets to our carbon emissions intensity and then taking actions based on a combination of the carbon emissions intensity, but also, the risk, the return, and the capital intensity, lots of other factors, right? It's one of a set of factors. And I think that's important to consider for everything in the portfolio. So we have kind of a minimum standard of understanding the carbon emissions intensity of every asset and knowing what the picture looks like to make sure that the whole picture moves in the right direction. And then when it comes to originating new assets, there's also kind of a minimum standard, right? And we have an exclusions list that we operate with. But in addition to that, we will proactively source assets that meet the new investment strategy that we might want to develop around natural capital, for example. Or we've done net debt for nature swaps and been really, I think, at the front edge of that new product space. We have an appetite to be a leader in the space. Of course, when we do those things, it still needs to fit within the risk management, the regulatory regime that we operate within, et cetera. That's how I think about the difference between new origination and portfolio management.
L&G has developed sector-specific climate strategies as part of your climate pledge that you already referred to. Could you maybe walk us through one example and make it real how in practice you're thinking about transition pathways to net zero?
In the property sector, right? I mean, property is a space where you can think very actively about energy efficiency opportunities. And we are a large developer in the UK. We fund a lot of development here, and we're starting to do much more in the US as well.
Right. And for higher risk markets, or let's say higher risk nascent industries, what sort of enabling conditions does LNG need to see that gives you enough comfort to move forward with an allocation?
I spoke earlier about being a correlation strategist and looking at how to invest in a market when there wasn't much track record. That's hard for the likes of LNG because we operate with a regulatory regime that reviews our models, right? And the rating agencies, we anchor a lot on credit ratings. And so both of those things mean it's very hard for us to invest where there is no track record. It's very hard for us to invest where there's no track record that has lived through a credit cycle or two. So even track records that go back 10 years, 12 years from here, it's difficult because they haven't lived through the global financial crisis and they don't have that kind of history of a lot of volatility and having weathered volatility to really gain that comfort. That's one of the things I think we have to grapple with. And to be honest with you, as someone who comes from a higher risk appetite investing background, I'm very conscious of placing that line in the right place, given who this institution is and the money that we're managing. I had the pleasure recently of visiting one of our offices outside of London. It's in Hove, and we have there a customer service desk. And so I got to meet the customer service team, and someone said, "Oh, why don't you do some call listening?" So I had the opportunity to just listen in on 2 customer calls, and they picked up the phone. I mean, you've known this from the other side, right? It's a bit like what you said about teaching. You know it from one side. So I've definitely been on the other side to customer service agents, but here I was on the receiving end. This individual called in from Saskatchewan in Canada, and they said, "Oh, I'm calling to give you a new address because I live in such a rural location that nobody can find my house. So I'm opening a post office box and this is the address. Please, can you send all my things there?" And it just made it very real. You know, there's this person on the other end of the phone, and that is who you're working for. And so I take very seriously how we manage risk. And so while I want to support new markets and, be innovative, I always come back to that person on the other end of the phone when I think about where we should be setting our risk appetite or how much track record needs to be in place before we engage.
You have mentioned to me that you really want to build LNG into an impact brand. Where has LNG been coming from in this perspective, and where do you want to see it go?
So part of the reason I joined LNG is that it is grounded in its own values. And I think that institution has lived with those values for a very long time. It has a natural inclination to be investing for the longer term. In fact, they've just relaunched our purpose statement this year, investing for the longer term. Our futures depend on it. And so that's a powerful statement. You asked me as well about being a long-term investor, right? And so that I think is an invitation to demonstrate leadership, to bring a different perspective that's linked to that long-term future that we want to see. So there's a great fertile ground in which to kind of continue building on that legacy. So what I would love to see is that we're recognized for that work. I think we're a recognized leader from an asset management standpoint. I think there's a great reputation on that side of the house. And so really for me, it's about the institutional retirement division developing its place in the world as an asset owner who is incorporating climate decision making in our investment process.
Looking ahead, what systemic changes would most effectively increase institutional capital flows into impact investments and even perhaps emerging markets in the future?
Well, it's a very interesting time in the world to be asking this question. My biggest worry is that they will decrease from here, I think. We need to think about impact as an intrinsic variable that exists whether you like it or not. I, for one, feel it's very important not to lose sight of that. If we stop paying attention to it, it will manifest as risk. Someone else said this to me recently. We should be calling this value at risk, right? Or once upon a time, I think Al Gore called this stranded assets, the risk that the world kind of moves away from certain assets and their value drops. I think that the societal trends of what's valued and not valued, right, can be quite political. But at the end of the day, I think about what kind of property attracts tenants today. It is an energy efficient property will attract tenants, right? Because it will cost less to run. I don't think that's going to change because people don't like the term ESG. I think where there is a strong commercial impetus, that should stand the test of changing political winds, personally.
I think if we had this conversation 2 years ago, we'd be talking more about ESG than impact. Now that it seems like impact is much more mainstream, ESG, especially in America, is, people are scrubbing their websites right now.
The thing that frightens me the most is people operating out of fear. I don't like the idea of changing the words we use because we're afraid of what people will say about that. But I also think that this is a sector that has been very confusing in the language. I appreciate the opportunity to be clearer about what we're trying to achieve. And, people have talked about greenwashing and the risk of overinflating what you're proposing or what you're trying to deliver. And that is a real risk.
There's not common definitions of an awful lot of things. And that has led to confusion. And then, of course, that's led to some out there trying to jam this down people's throats without being able to describe the benefit. The only way this will become mainstream is if it is a better way to invest. So then we should be able to explain it better. Yasemin, I've got a few rapid fire questions for you before we wrap up here. So don't overthink these and just give me whatever comes to your mind. Or if nothing does, feel free to take a pass. That's okay too. If you had to name the single most important challenge in the impact investing space at this time, what would it be?
I think it is probably validation of the actual impact. So I think that the operating principles for impact management have helped people set out how they manage impact. And there are people validating that process management. But what actual impact happened on the ground is still a very expensive endeavor to solve.
What do you know now about impact investing that you wish you knew back in 2010 when you first started focusing on impact investing at the social finance team at JP Morgan?
That intent is the crucial factor. That would have saved me 4 months.
Okay. You are an investor. You don't have to name names. But can you describe an investment you made that you were convinced of at the time you invested, that it ticked all your impact boxes, but in the end, it just didn't turn out? And what were the lessons you learned from that experience?
There are probably two investments that come to my mind where we were presented with an opportunity to back a team that was launching a first-time fund that would invest in geographies where the team was not based. And so this comes to the point of local presence. Both of these funds were models where not only were the team not based where the investees were based, but they weren't even based together. So 2 times this has crossed my investment committee. And in the first instance, it worked out well. And in the second instance, it remains to be seen. I suppose that premise that, an effective investment team should be co-located with each other and with the geography in which they're investing is definitely a lesson that I've learned from some things that have either still got question marks over them or haven't quite worked out.
Now I'm going to ask you the converse of that. Can you describe an investment that you had some level of skepticism about, either at the time you invested or maybe you ultimately passed on it, and in the end it turned out way better than you thought? And what was the lesson that you learned from that?
I have an example from my personal life, but it wasn't a decision to pass because I couldn't take the risk. I was told not to invest for compliance reasons. So I don't know if that's really what you're trying to achieve in this, but I spotted a company in its early days. I convinced the founder to allow me to come in below the minimum ticket size as an angel investor because I believed in the space they were going to occupy in the market that was growing. And because of the relationship with the institution I worked with at the time, the head of compliance there said it wouldn't be appropriate for me to make that investment on a personal basis. So I withheld. And after that, the next round, so the Series A funding round, I believe they got 2 significant institutional investors. And to this day, I have not forgiven them the head of compliance or the CEO for me missing that investment. I honestly would have left my job to make that investment at the time. I jest, but it was a missed opportunity that I do still think about today.
And if someone wants to get into the impact investing space, where would you advise them to start out at?
I think my time on a kind of mainstream trading floor has served me all the way till this day. So I would advise people to ground themselves in the fundamentals of global capital markets in a mainstream bank. And, one where they enjoy their time. I'm not saying sacrifice everything, but go and learn the core of how financial markets work and then bring the impact lens on top of that. If you can parallel track it well, great. But I think that foundation has served me hugely, and I wouldn't be where I am today without it.
A lot of people say that. Yasemin, I want to thank you. You've been great. We've covered a lot of ground here today, and thanks so much for taking me through all this. I learned a lot. Now, tell everybody about your website and your social media and how they can learn more about all the great things you're doing at Legal in General.
Yes, Legal in General is a publicly listed company, so you can see our quarterly results and our share price on a daily basis if you wish to track our performance. But yeah, there's a lot of information on our website about institutional retirement. We held a Capital Markets Day in December that tells you more about the specific division that I work in. If you want to learn more about the pension risk transfer business and the market that we're a part of. And my LinkedIn profile is live. I wanted to thank you too, Scott. I am quite a private person, so it's not been the easiest thing for me to talk through some of the questions you asked me, but I've really enjoyed our time together. So thank you for inviting me on the show.
And what's the best way for people to contact you?
They can drop me a LinkedIn, probably.
All right, everybody, check out the legalandgeneral.com website online. Lots of good information there. Yasemin, thanks again.
Thank you so much, Scott. It's been really fun. I appreciate you having me.
All right, goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.